I'll try to get the exams Sunday, Monday. We'll see with spring break. I don't know if midterms are due on Monday or not. I can't remember. Um, we'll see. I'm always worried. Students have had me before. COVID really changed students. Um, I, you're supposed to spend about 6 hours a week on a class or 2 hours every 3 hours. And so on the exam, that's about 20 hours of prep for the exam. For the paper two, it's about 40 hours. So that's your 60 hours of the first 10 weeks. Get some exam in my class and it feels like the student might have spent an hour, which is not enough. But I think so many students, because of COVID, because we watered so much stuff down in COVID, a lot of students like, yeah, we should get a degree with how much effort. And it's like, no, a lot of effort. You heard those that went and saw the CIO yesterday, or when was it? Yesterday. Yeah. And he was talking, you got to know the details. It's extremely important. And yeah, the details, that's the key. It's learning really hard stuff at a very, very deep level. And a lot of students, it's like, I'll do that when I get my job. College, it's just, it's textbook. It's not that important. You don't have a textbook in this class for a good reason because textbook stuff does tend to be a little out of date and impractical. But the stuff we're doing is exactly what the CIO of USA is doing. You could go and debate with them. We didn't get any technical questions yesterday. I was hoping for some. Um, I could have asked some because I'm really curious what they're doing now, especially given what's going on with the bank. So it'd be interesting, but he didn't get into that. Um, some students really struggle in my classes because they're supposed to spend 6 hours a week, and yet you get an exam and a paper, and it's like, what do I do the weeks where the exam doesn't happen and you're supposed to be prepping in those weeks? And if you don't like that, then you're probably not gonna like finance because finance, I was an accountant for 2 years, and my entire life was dictated to me by the minute. I knew exactly what to do all day long. Every day I came in and I had these projects. Finance, it's like do your job and your boss might talk to you every 3 months. You better have done something that 3 months. Because so finance, I love it because it's one of the most autonomous jobs there is. You don't have the accounting cycle where every month, every week, every day you've got stuff to do, but you work on a project and you gotta present it. There was projects I worked on for 9 months and I was working on them hard, meeting with people, ready to present them. The fact that something wasn't due tomorrow, that didn't slow me down at all because I knew we had a big project. So it's tough. Some students really struggle in my class, and I don't enjoy that. I wish everybody would do well, but it is tough after COVID. But I do want to shift gears here for a big essay question for the second exam. We talked about how correlation and diversification is the number one risk tool in finance. So one of the reasons this class is your senior year and it's a senior level class, it gives you an opportunity to question the stuff you learned in earlier classes. This will actually question what you're going to do on the risk project for this class. I do have a blog on this one that you can read. I have not updated the numbers because I didn't want to contradict with the blog, but I'll try to show you some updated numbers. So I did this a few years ago. I've done this at a few conferences as well. I do try to update it for those conferences, but so this might seem like heresy to the pure PhD professors. I think a lot of them teach this, thinking everybody does it just like this, not realizing the incredible frustration. I think you're going to see the frustration on the project too. One of the reasons I want you to do it is you can see a real life example, but while you're doing it, going, man, does this really work? Would I really manage money this way? A lot of people do, but we'll see. So we'll go through this. So we're questioning something that is sacrosanct. This is a pretty sacred concept in finance. Does it work well for mitigating risk? So I'll give you some history of this concept of diversification. You might think, well, we've always thought diversification worked. Didn't the Romans, ancient Romans, didn't they diversify their portfolios? And they're really key to this question is asking it at the individual stock level and asking it at the portfolio level. You're going to see for me, I think it works well at the individual stock level. It works well, but not perfectly. It certainly has its downside. I really question if it works well at the portfolio level. And then I'm going to show you some real heresy. I'm going to show you some quotes from some hedge fund managers and their critique of correlation. And then you're going to say, well, wow, you don't leave us with anything. I'll show you what they say you can use instead. They say, forget correlations, think environments. And so not that you would actually do this, you can stick with the traditional approach that you're going to do on project 2, but I want you questioning it. I'm going to do another podcast with the Investment Society. My first topic was on, they're asking about my history and my career. My first topic was knowledge is power. Early on, you learn the hardest stuff as fast as you can, and suddenly early in your career, you're involved in these massive decisions because you did all the legwork. My second one is going to be on questioning convention. Y'all have already kind of heard that with what we did with our pension plan at USAA, questioning the convention. So here's a place to question convention. If you throw out convention, then you have to think, what am I going to replace it with? And that's getting tough. Know what to do with it. And so we will talk about alternative approaches. There's 2 alternative approaches I'm going to talk about. One is the environment approach instead of correlations, and the second one is the option approach. And we'll look at both of those and see. We used the option approach at USAA with incredibly good success in 2008. So we'll look at both of those. So some of the history. So has diversification always been believed in finance? And I'm worried to put people in my presentations anymore. When I did this presentation at a conference, I said, oh, William Annell, wonder how he's doing. He had just died the week before. And then I did another presentation, and Markowitz is in it, and he had just died the week before. It's like, man, if I'm not going to stick in my next presentation. I'm not going to put William Sharp in any presentations. But so this is William Annell. He's pretty famous. You can look him up. You would think he was someone that would believe in diversification, but this is what he said. Diversification is a hedge for ignorance. I think you're much better off owning a few stocks and knowing a great deal about them. This is really key. He's talking about knowledge versus diversification. What does diversification do? You got a lot more securities, but what's your knowledge on each individual security? It's much smaller. He's saying knowledge, deep knowledge of a security is more important than diversification. By being very selective, you increase your chances of picking superior performers. You can also watch the stocks, so you can monitor much more carefully, which is important in controlling risk. Now, he wrote this many, many years ago, so I'm going to question this in the computer age, because in the computer age, can you monitor 500 securities pretty closely? You can. If you have, and those that got to hear Ricardo speak Tuesday night to my security analysis class, he's monitoring securities very carefully, but AI is doing most of the work and computers are doing most of the work. He wrote this before you had that. He wrote this when annual reports came out like 45 days after the end of the quarter. You didn't have a lot of information. So the information age may have changed this dark argument. He probably changed his mind somewhat after time, but he said for an investor with 5,000, hold 1 or 2 stocks, 10,000, 3 to 4. So maybe 6 or 7 stocks. That's not good diversification. And we'll see what finance theory says about that. Take an even more famous name, John Maynard Keynes. You got a Fed chairman, took us out of the Great Depression. As time goes on, I get more and more convinced that the right method in investment is to put fairly large sums into enterprises which one thinks one knows something about, and in the management of which one thoroughly believes. So again, he's saying the problem with diversification, it reduces your detailed knowledge of your securities because you have to hold more securities. So he thinks diversification is actually a mistake. It is a mistake to think that one limits one's risk by spreading too much between enterprises, about which one knows little or has no reason for special confidence. Today I was talking to a student, he's doing an evaluation of United Health. Anybody have a sense of how complicated United Health Group is? Does that sound like a complicated company or a simple company? Pretty off the charts complicated. $500 billion, or used to be $500 billion company. The government's talking about kicking off the PBMs. It's got insurance, it's got uh, healthcare. It's got PBMs. And it's really complicated. I spoke to two students who work for them. In fact, one came and spoke to my security analysis class. It's an interesting organization. You can look them up and see what Congress is saying about them. They've gotten some really, really bad press releases. Can you really, really understand United Health if it's one of 200 stocks in your portfolio or one of 100 stocks in your portfolio? That's a complicated company. Um, One's knowledge and experience are definitely limited, and there are seldom more than 2 or 3 enterprises, 2 or 3, at any given time in which I personally feel myself entitled to put full confidence. Warren Buffett might believe that. He has a more concentrated portfolio, but he has a lot of control as well. You don't have much control over the stocks you buy. So there's John Maynard Keynes, another famous person. So it's familiarity versus diversification. At the bottom line, these two gentlemen that's speaking much earlier last century were talking before the computer age, before we had our hands on all this massive amount of information that we could bring in and look. But I think they might still think there's probably some wisdom to what they're saying, that having 50, 100 stocks in your portfolio, you're kind of kidding yourself being that knowledgeable. We'll see what the AI revolution does to that. If AI really can make better decisions. That's the question I asked Ricardo. Y'all remember the percentage he said was human? 13%. So the computer does 87%. My question was, what value is your 13%? And how do you know it's any value? Are you even doing anything on the 13, or do you just want to make sure you have something to do before AI puts you out of a job? But he thought his 13% was adding value. But my question is, how do you know? How do you know the 87% is adding value? His portfolio has done really well, but is that luck or is that skill? He doesn't have enough information yet. But he is getting around the familiarity by using a lot of computers and using computers very, very differently than we have in the past. He's not using computers to get data. He's getting computers to actually analyze data, and more than just numbers. He's using computers to look at actual text. What is the text saying? How are opinions changing? So he's using large language models to say, wow, the words, they changed these 3 words in their earnings release. That's more negative. Those 3 words are more negative. They're getting more negative. Their estimates are coming down. Those are the kind of things they're looking at. And then they start looking at supply and demand. To have all these things in there, does it work? It sounds pretty good. Sounds like they're going to do a lot better job than I'm going to do by myself without the computer. So I don't think I can compete with them. Sounds interesting, but that's the argument. So today, what you hear people saying, these are just quotes you can find anywhere. Investment diversification is one of the basic building blocks of a solid portfolio. Diversification is the fancy name for don't put all your eggs in one basket. This is the basic principle behind asset allocation, a key element to portfolio diversification. They're saying it's just basic. This is what everybody should be doing. Diversification is practice of spreading your investments around so that your exposure to any one type of asset, he's talking on the asset level, not security level, is limited. This practice is designed to help reduce the volatility of your portfolio over time. He said asset, not security, and he used the word volatility. We'll talk about that in the second part where we talk about diversification at the asset class level. Does it actually reduce volatility or not? I remember at USAA, it always bugged me. I was a security analyst at USAA. I was talking to, I don't remember who I was talking to. Was it one of y'all? I can't remember. But I had, 50 analysts or so out there, millions of dollars in salary. And I was standing outside the head of equities office, a guy named Harry. And he said, yeah, Ron, I like to come out sometimes and talk to analysts, just see what they're thinking. It's like, why are you paying us? He said, yeah, I mainly just use street research, but every once in a while I want to see what y'all think. Like, you're paying 50 people just in case occasionally you want to hear what we think. So there's no process. None of us really knew what our value was. Everybody's out there working their analysis. They're talking to portfolio managers, but there's no process. So when I became head of equities, I go to the fixed guys and say, what is it that is USAA? What makes us different than everybody else? What's our core beliefs? And the first thing he said was diversification. I said, well, no, everybody believes that. what is it that's unique to USA? And I knew what it was for fixed income, and they would never tell me what it was. It's like, I know what it is. You're all about spread. You believe higher spread beats lower spread, so that's okay. That blew up in '08, but it generally did you well. But what's your basic belief? What is it on the equity side? What do we really believe? I knew we were kind of GARP investors, kind of value investors. But that always bugged me at USA on the investment side. I think one of the reasons they essentially sold off to Victory and kind of outsourced everything is they didn't have this distinctive what is USA. I believe that's true with Fidelity as well. I do think there are firms that do have a very distinctive, this is our philosophy, this is our belief. You heard that some with Ricardo, those that saw him Tuesday night. Um, but that's the first thing the head of fixed income said is, oh, USA, we believe in diversification. So yeah, everybody does. What's unique to us? So that's just so basic. It's the first thing people will say, diversify your portfolio. One way to balance risk and reward is to diversify your assets. Again, they use the word assets. So are we talking about securities or are we talking about assets? This strategy has many complex iterations, but at its root, it's simply about spreading your portfolio across several asset classes. He's talking asset classes. I'm going to say I agree with him on the security side more than I agree with him on the asset class side. Diversification can help mitigate the risk and volatility of portfolio, potentially reducing the number and severity of stomach churning ups and downs. Bottom line, the promise and power of diversification is that much risk completely disappears with only a small impact on expected return. That's what it says. You can get our expected return, but by diversifying, we get all these asset classes around the globe. They have a return about 8%. Each of them have a risk about 30%. If you put them together, you keep your 8% return, but your risk comes down to 15. It's just magical. It sounds wonderful. But does it actually work? All right. Remember, I want you skeptical but not cynical. So don't get cynical on me, but do get skeptical. Be careful in interviews that you use too much of this class in interviews. Because I was showing one guy he's interviewing, and I showed him all the traditional stuff. This is what they're going to believe, and this is what they're going to say. Does it work or not? I don't know, but this is what they say. So let's look at the individual stock level before we do the portfolio level. So you already know the capital asset pricing model. William Sharp, back in the 60s, he came after Markowitz, came with the capital asset pricing model. It's a one-factor model. He says a security, we're at the security level, right? Keep really, really clear. At the security level, an individual stock has two risks, systematic risk or systemic risk and unsystematic risk. Systematic risk, also known as market risk, is the risk of being in the economy. It's just the risk of buying stocks. Unsystematic risk is company-specific risk. This is also known as idiosyncratic risk. It's risk that's specific to that company. And so Sharp says, yeah, a stock has systematic risk, has unsystematic risk. You add these two together, you get total risk. How do we measure total risk of an individual security? Anybody know? What did you learn in stats? What statistic do you use for total risk? Standard deviation. So you can break standard deviation in between systematic risk and unsystematic risk. William Sharp says the market's only going to pay you for taking systematic risk. It will not pay you for taking unsystematic risk. Why? Because you can eliminate it cost-free very easily. If you can eliminate a risk and it's free, it doesn't cost you anything to eliminate it, there's no reason for the market to pay you for taking that risk. So you could put all of your money in one stock. So you go put all your money in Palantir, 100% of it. And when you do your analysis, got a standard deviation of 40%. So you use a really high discount rate and you get a valuation of like $2. And then you look at Palantir stock. I don't know what it's trading at because I would not buy Palantir, but you look at it, it's trading for many, many times that. You call your broker and says, I want to buy Palantir for $2. Or like $2. Are you kidding? You're not going to buy it for $2. Yeah, but I did the risk analysis. It's very, very risky. Using that discount rate, I get $2. And he said, yeah, you're using the wrong discount rate. You're using a discount rate for that being the only asset in your portfolio. Everybody else is assuming that's an asset with a bunch of other securities around it. They're using a much lower discount rate because they're not using standard deviation to come up with their discount rate. They're using just systematic risk. How much of a stock's risk is systematic and how much is unsystematic? What's your guess on that? I'll show you some charts. The most of the stock's risk is what? Systematic or unsystematic? Majority is what? Majority is unsystematic, about 85% of a stock's risk, which means when you put a stock into a portfolio or 20 more stocks, 85% of its risk disappears. That's pretty exciting, isn't it? Anybody know how you figure out the percentage of stocks standard deviation that is systematic risk? Any guesses? I might be able to show you. Back when I taught my investment class. I didn't do it. I didn't do that. Didn't do it there. I know I did it. Oh, there you go. So here's Walmart's monthly returns. Here's the S&P 500 monthly returns. So Walmart return, SPX return. What one simple ratio can I do to get the percentage of Walmart's risk that is systematic? Any guesses? I'll give you a hint. It starts with an R. It's not on that list though. It starts with an R. R squared. That's exactly what it is. R squared on Walmart's. So 24% of Walmart's risk historically has been systematic. How much is unsystematic then? 76%. So for Walmart, if you buy Walmart stock, put it in a well-diversified portfolio, 70% of the risk is just going to disappear. Pretty amazing stuff. So that's the theory. You need about 20 or more stocks. You need to be in various industries. You can't have 20 tech stocks and get that same result. You need to be diversified across different industries. But if you do that, you'll probably eliminate 100% of your company-specific risk, which is pretty good. That's 76% of your risk. Pretty exciting. So if you look at it with 10 stocks, I just pulled 10 random stocks together out of different industries. Here's your return as you do, as you add, I think you add Apple and the return goes up. You can see the return does bounce around if you have one stock versus two stocks versus three versus four. The green is the average standard deviation of the stocks, but the red is the standard deviation of the portfolio. So you notice as you add more stocks, the actual standard deviation of the portfolio is much lower than the average standard deviation of the stocks. That's that diversification. Why? Because when one stock's up, another one may be down, and one's down, another may be up. They offset each other. There's a lot of risk reduction there. I'm not going to do that chart. So it works really well with one big problem. I don't know if I can show this to you or not with Walmart. I wish I had a different stock besides Walmart. See if I did another stock in another class. I think I did Apple in one class. Here we go. This will be good. This is Thor. Y'all know who Thor is? Produce Winnebago's and whatever. What kind of bait are they going to have? So that's their percentage of their risk that's systematic is 24%, very similar to Walmart's. However, if you look at this, over time, sorry, I wanted to be able to do the copy function. If you look at it over time, is it always 24%? That's the percentage of the risk that's systematic. Is it always 24%? Sometimes it's almost 0%. That's pretty cool. You put Thor in a portfolio and almost all of its risk disappears. But sometimes it's what? Sometimes it's 60%. Wouldn't you love to see the year that is the 60%? What year do you think it might be? When do you think the correlation goes up? What kind of year would the correlation go up, do you think? 2008 might be a good candidate. I don't know where the graph is. This is one thing I hate about what Warren Buffett does is you kind of lose graphs. Here's 2008. How did it do in 2008? It jumped up to above 40%. When would you want diversification to be helping you? What year would you really love diversification to reduce your risk? Maybe 2008. When does it not reduce your risk? 2008. That's kind of a flaw, isn't it? What about the recession at 87? Jumped up there. What about COVID? Jumped up there. Wow, that's kind of disappointing, isn't it? So your number one tool for diversifying your portfolio, for reducing the risk of a portfolio is diversification. Works really, really well unless what? You need it. Otherwise, it's that fire extinguisher. It works really well unless temperatures are elevated. It's the airbag that works well unless your car is seriously damaged.
Get the R square, you compare it to the S&P 500 and
The returns. You just take the returns of the stock, the returns of the S&P, the R squared of that is the percentage of its standard deviation that is systematic. 1 minus that is the amount that's going to disappear when you put it in a diversified portfolio. But that R squared is not a stable number. And when does it shoot up? It shoots up when markets are crashing. So,
how do you know how many stocks you need to add to?
Well, that's just, there's been studies on that. Most people say around 20, you really eliminate all of the systematic risk if you're diversified across. When I did show the 10 stocks, I had banks, I had retail, I had energy, I had tech. So I had diversified across. So around 20, you've eliminated all of that.
Would you use suggested R square for that?
You can. For this purpose, it's not going to give you, because I was using like 30 years, 40 years of data. So but I mean, just the basic concept of diversification, it works well. I usually don't because I like it to tie with my correlation numbers. So it's I just use the basic formula in Excel. All right, so it does an excellent job, but it's not stable. And during a crisis, so here I did those 10 stocks again, and I took the median of their R squareds, and you can see in 2008 that R squared jumped up to 60%. So you have much less diversification because they're all reacting to the same thing, right? What was the one stock that had a positive return in 08? In the S&P 500 was Walmart. Kind of makes sense, right? Walmart was the one place people were all running to because they were scared of losing their jobs. Exact same issue with beta. Betas are not stable. Betas don't jump up in a crisis. And why is that? Because the beta of the S&P 500 is always what? Always 1. So if one stock's beta jumps up, what does another stock beta have to do? It has to come down. So betas don't jump during a crisis. This is Walmart's. Its beta fell in a crisis. But beta is also assumed to be a constant number, and it's not a constant number. It's all over the place as well. If you take my secure analysis class, my investment class, I talked about how to get around that beta issue, and instead of using historical beta, you use a forecast instead. But betas are pretty unstable. Should Walmart have a 1.4 beta? Absolutely not. But it was a small, young company back then. Since the last 20 years, it's had a beta closer to the 0.4 level. Makes more sense for Walmart, but very unstable over time. So that's at the security level. Makes sense to be diversified at security level. It does give you quite a bit of protection, but you will probably still lose a lot of money if the market crashes. I think the last couple of weeks, you've seen energy stocks up a bunch, so that's a good argument. And that's one of the reasons beta is so unstable, is because beta is a one-factor model, but there's many systematic risks. There's interest rates, there's oil prices, there's the economy, there's employment. And so what's driving markets keeps changing. So in the financial crisis, you saw betas of banks shoot up because that was crisis. And the dot-com crisis, you saw tech stock betas shoot up. So that's another problem with CAPM. It just assumes, the market is the one factor, but there's many factors going on. So diversification does help you with that. So you're glad you had some oil companies in your portfolio this last couple of weeks. Probably wish, we bought a defense company. We bought Northrop. We're glad we had that in our portfolio. We bought a software company. We're really glad. We're really upset that we have that in our portfolio. That one really crushed us. But the diversification does seem to help. But this market hasn't been that big of a sell-off. It's not been that crazy like we saw in 2008. So if you see a major sell-off, you'll probably see maybe a sector will do really well. If oil prices is the driving force, you might see oil prices, you might see materials, any of those that tend to be the more protective of against inflation. Although I don't think gold did well today, did it? Did y'all see oil prices today? Last couple of days, it's been a little bit scary. Yeah, I don't know why they changed this. So 10-year bond is its yield been up or down? That was my dashboard team. Where's the 10-year yield last Friday? Its lowest level since November. It fell below 4%, 394. Where is it today? It's back up to 415. That's 20 basis points in 4 days. Is that a big move? That's a big move. Yeah, this bond market, I can notice it in my bonds. Bond market has been selling off pretty dramatically. Then you look at commodities. Gold did do well today. But has not done as well as you would have liked in this last crisis.
The year today is pretty high for that, but
Yeah, even though they had that massive sell-off that one day, silver is not quite recovered. But yeah, it's over the last year or so. So if we look at oil, Yahoo keeps changing their site. I get used to it and then they change it. So you look at oil. The oil's still trading, so it's down a little bit tonight, but it's pretty amazing. We're approaching $80, which is pretty crazy because we were down in the 50s there. So from $60 to 70 to 80, $65 to 85, $80. That's a pretty big swing. So could oil have protected you this last week? Oil itself, could you have instead used Exxon? Helped you some, not as much as oil though, right? So what about Valero? What's the problem with using Valero to hedge against oil prices? It is up a bunch, but does Valero sell oil? They buy oil. So that's a cost of goods sold for them. But what else is going up besides oil prices? I don't know because I don't buy gasoline, but is gasoline prices going up? Can y'all notice it? I haven't bought gas in quite a while. I buy gas like once every 18 months. So I don't notice. But do y'all notice some of y'all have gas engines? You notice gas prices up?
This, KBP is, it's oil, wells here in Texas.
Oh, sorry. I don't even look up. So here's gasoline. All these pop-ups are so irritating. Here's gasoline. Let's do weekly. Yeah, it's from $1.50 to 267. What are y'all paying for gasoline?
I paid, the last time I filled it was like 270.
270. This is actually pretty close to San Antonio. You couldn't get these prices in California, but pretty close. So that's a pretty good jump.
It was doing great.
If it passes $55, then it's still no.
Oh, yeah. Yeah, I'm kind of glad I got my plug-in. So it's why Valero's up so much is interesting. Maybe they have a reserve of oil they're sitting there that they bought back for $55 or something. Who knows what's going on? But they're up more than Exxon. That's kind of interesting. But say, well, I'm good. I got Exxon in my portfolio, but you don't have Valero and Exxon 40% of your portfolio. So if the market sells off and energy's up and you have 10% in energy, it's still not going to do you that much good. So when markets really sell off, having something that's up is not going to help you unless you have a whole bunch of that or it moves in a massive amount. We'll talk about the black swan approach to investing. So, all right. So at the asset class level, so individual stock asset class. So what's an asset class? Can you name a few asset classes? As a finance major, maybe 10 you could name off the top of your head, maybe. Commodities you could do is one. Some people might put them as an alternative, but you could have them as a separate class. Yeah. So I said stocks. How do you break stocks up? Well, that's sector. We don't normally count sectors as asset classes. Some people do. No, those are vehicles.
What about credit ratings?
Well, that on the bond side, I'm talking on the stock side. The credit ratings would work. No, so you have large companies,
Small cap.
mid cap companies, small cap, and how can you break up large companies? You're going to do this on the project style analysis. You have large cap growth, large cap value, and what do you call it when it's in between? I can tell none of y'all took my investment class. I'm going to be teaching that again in the fall, so that's good. So you have a large cap growth, large cap value, and large cap core. Then you have small cap value, small cap growth, and small cap core. What's been doing really well the last few years? Large cap growth. What's been doing really badly? Small cap. So those are asset classes. On the bond side, credit ratings can work. We typically talk about high quality and high yield. On your project, that's all I'm going to have. I'm going to have investment grade bonds and high yield bonds. But how else could you break up bonds? So Vanguard came up with this system. They had 3 categories. So you mentioned credit. How else can you do? What did we do on exam 1? What term did you use? Starts with a D. Duration. So you have credit quality and duration. Vanguard broke it into 3 categories: short term, intermediate term, and long term. So those are your asset classes. We don't use that many asset classes, but if you read William Sharp, you can see his asset classes. He has 13. At UTSA, we had 26. But that's because I had a taxable corporation and a non-taxable corporation. So I had to do things after tax. I had to figure out, where do I put the stocks? Do I put them in the taxable entity or non-taxable? And we had to do analysis like that. So I had 26 asset classes. So that's the asset class level. What else can you do for stocks? Large cap, small cap, mid cap, growth, value, core. What else can you do besides US stocks? So how can you break up non-US stocks? We have 3 categories there. You may know those. So developed markets. What else? emerging markets, and then what's the itty bitty bitty ones? Frontier markets. You should really know these. Have them on a list. If you're going to interview with wealth management, have a list of like 13 asset classes with you. So US, you have large cap, small cap, mid cap, growth value, core. International is usually developed, emerging, frontier. You can do developed market growth, developed market value, developed market core. Most people don't. They just do developed market. So the UK, France, Australia, Canada, those are developed markets. Emerging markets, I can't remember where's where. I think South Korea is developed. China's still developing. They're not a developed market. Japan would be what? Developed, definitely. So it can be a little tricky. There are some that are a little bit on the edge. I know South Korea has been one of those that's kind of been debated. Where did they go? And then on the bond side, you have investment grade, below investment grade. You can break it up short term, intermediate term, long term. There are some people. So Brenda mentioned commodities. Some people put those in alternatives. Some people put emerging market debt as an alternative and developed market debt as an alternative. At USAA, we did not do non-US debt except for in the pension plan, because if you buy non-US debt, if you buy like UK government bonds, you're going to discover real quickly you're not buying UK government bonds, you're buying the pound. You're going to discover that the currency takes over that entire portfolio. So you're not betting on anything except for how does the pound do, because it's just so much more volatile than the interest rates. But for stocks, international stocks work really well because the currency versus the stocks, they kind of have equal risk, and the currencies actually gives you some diversification, which is kind of nice. So those are the asset classes. Real estate could be an asset class. At USAA, we had as an asset class. Some people put that as an alternative. Private equity is usually an alternative asset class. I was showing Mason today that an endowment like Harvard has over 50% of its assets in private equity. Just crazy. You know, a very illiquid asset. It's done very, very, very well for them. But then they, you know, a lot of private equity people in that field come from Harvard. Harvard really supplies that particular area, so that's their thing. And then what else is alternatives? Things like infrastructure, collectibles, you know, so have some idea. You can Google alternatives. Some people put Bitcoin as an alternative. I put Bitcoin as a don't touch because I don't understand it. Some people put hedge funds as an alternative. I do not agree with that. To me, hedge fund is an alpha play. It's a way to beat the market. You're hiring someone to give you alpha, not to give you beta. So asset classes, think of that. Asset classes is your beta risk. To me, hedge funds is your alpha risk, how you're trying to beat the market. Remember when we talked about alpha risk versus beta risk with Robert Arnott. So we're talking here your beta risk, those asset classes. And there are other ways you can break it up. You notice I didn't say cash. Most people don't have cash as an asset class because it just doesn't ever get allocated to. It doesn't look like a good asset class, but you could put cash in there. Anybody think of any other asset class I haven't done?
You said infrastructure. I'm thinking specifically energy infrastructure.
Yeah, you can break infrastructure into some pretty incredible categories now. I talked to a student last year. He was doing fiber cable infrastructure and just investing in that because he's working for a real estate company. So a lot of that is real estate. So yeah, you can get pretty specific. One alternative I saw was music royalties. That's not infrastructure, but you can do that. Catastrophe bonds, I love that. Could that be an asset class, or you just lump that in with high yield bonds? So you decide where you break it out. So if you want to break out sectors as asset classes, you could. Most people don't go quite to that level because it gets a little cumbersome. In my investment class, I talk about what we talk about. We use the term parsimony or parsimonious. You want enough asset classes so that you can really control your risk, but you don't want any more. So if 13 is the right number, you don't want 14, because every time you add an asset class, you now have to go interview 20, 30 firms and pick one to hire. And that's a lot of work. At USAA, we were interviewing 5 to 10 firms a week. It gets really tiring. We actually, at one point, like 2 years into it, I said, you're not allowed to visit us ever again.
we're only doing these by phone. They want to visit, right? Because they get credit for visiting us. It's like you can call us from our parking lot if you like, but because poor Michael, who is one of my best workers, was spending all his time running down to the lobby to pick up. Yeah, there was a lady who worked in the lobby. Her name was Trisha, and I kept joking with her that her last name was in the lobby because it's like, this is Trisha in the lobby. And I was like, yeah, we're coming down. We know they're there. So it's tiring. You don't want 15, 16 asset classes. So some people are like, let's make real estate investment trust an asset class. Oh, I don't want to interview 15 real estate investment trust companies. Let's just classify it as a small cap stock. That's really what it is. All right. So Williams Tower has a great paper on this. Arsamini, you want enough asset classes to cover your risk, but no more. He says it's 13. We had 13 at USA. There were a different 13, but we had 13. So this is what you're going to do on project 2 is the Efficient Frontier. I've already built it for you, so you don't need to build it. Although I do believe you should be able to, with a blank Excel spreadsheet, building Efficient Frontier from scratch using that formula. Anybody remember the formula? For 10,000 bucks, can anybody remember the formula? What's the first thing in the formula? The weight of A. Y'all completely forgotten it. The weight of A squared. And then what? Plus times divided plus B
The standard deviation of B.
plus times
Two.
plus 2
Times. Weight of A.
weight,
Weight of B.
weight,
Risk.
risk times what's the last little part? Correlation. And then what do you do with all of that? Take the square root of it. I promise you, you better know this formula. That's the most important formula in finance. We use it all. You're going to use it on the second exam, so you might as well learn it now. Are you memorizing it for the exam? No, you're learning it for life. I mean, try that with your mom. Hey, mom. Hey, Sharon. I memorized your name just in case I'm coming home for Thanksgiving. That doesn't go over well. There's certain things you just know, right? They're just inside of you. And as finance, we know formulas. We can picture them as soon as we hear them. We see the entire formula. We know how it works. So the inputs are expected return, risk, and correlation. And you saw how correlation reduces that standard deviation. If it's 1, it doesn't reduce it at all. It's just the weight of the 2 risks. But as it drops below 1, your risk starts coming down. So your Efficient Frontier starts blowing out. So you get more return at each level of risk. And what Efficient Frontier says, if with these inputs, there is a superior portfolio at each level of risk. And the low negative correlate assets, they have the most power inducing risk. So what are those assets? So gold is an interesting example because it has a really low expected return. In fact, we don't really know what the expected return gold is other than maybe inflation. Why would you buy? And it has really high risk. It's a very volatile asset class. Why would you invest in something that has a low return and high risk? Because it has negative correlation or low correlation to other asset classes. So that correlation can offset. In fact, in that case, if you have negative correlation, the higher risk actually helps you. If you look at the formula, you actually will see that having that negative correlation applied to that very, very high risk helps reduce the risk quite a bit. But are there any reliable negative correlated assets? So in 2022, bonds dropped 22%, stocks dropped 20%, gold dropped. Inflation-linked bonds dropped. What's the only thing that would have worked in 2022? Oil. Right? Oil prices were up. So it's tough. Well, gold is not a reliable hedger of risk. I'm surprised it didn't do better last week than it did with the Iran. Or was it last week? This week, right? Man, I'm getting my weeks mixed up. It seems like it was 2 months ago. I've read 2 months worth of articles on it. So yeah, it's getting kind of tiresome and nothing's resolved. So it's getting kind of repetitive what we're reading. And yet we really don't know what's going to happen. But gold hasn't helped you much there. Oil did great in 2022, did great in this crisis. But there's times when oil's been a disaster to have in your portfolio. and how much are you really going to put in oil? Are you going to put 40% of your portfolio in oil ETFs? That would be crazy as well. So, so it's tough. But that's the theory, and this is what you're going to do in project 2. It's all set up. You'll see it. It will give you that optimal asset class. And it's really good as long as my inputs are good. You're stuck with my inputs. You'll want to put that in your paper. That's actually one of the most important things is who came up with your inputs. Are my inputs any good? They're as good as anybody else's. It's a tough thing to come up with good inputs, but that's the theory. Expected return, how do you get those? With bonds, we talked about this earlier, it's pretty easy, whatever their current yield is. If you're doing high yield bonds, it's their current yield, and you subtract some for defaults because you're going to have some. That's why I would not buy high yield right now. Their yields are just way too low. But for investment grade bonds, yeah, your best estimate is what are the yields today, and you can get that very easily. That's pretty easy to do. Stocks, I use the current yield on stocks plus expected earnings growth, and expected earnings growth, if you take my investment class, expected earnings growth is essentially tied to U.S. economic growth. You look over the long term, our economy's grown about 6%, and corporate earnings have grown a little under 6%. You might think corporate earnings grow faster in the economy, but they don't. They grow about the same speed. In fact, they grow a little more slowly because I'm using the S&P 500. Large companies and small companies tend to grow faster. So if I'm just looking at large companies, they actually grow a little more slowly than the U.S. economy. How fast can our economy grow? So there's 3 parts of our economic growth: productivity, labor growth, and inflation. Productivity growth was incredible last year. Why do we have such great productivity growth last year?
Yeah.
Well, maybe AI and yeah, kind of indirectly is AI. So this is actually interesting. If you get into an interview, I think you want to bring this up because I think this is actually pretty topical. So 2025, our GDP grew well. I think it was like 2.2%, which is pretty good if you compare to other countries. But driven by what? Investment. Investment in what? Data centers. So when the economy is growing by investment, what are you assuming? So you got economic growth because you're buying building data centers today, but you're hoping they're going to produce a lot of growth in the future. Is AI going to produce growth in the future? That's the big question, right? So that's why software company stocks are down so much. Was kind of what the market, we wrote about this. I think Bloomberg's copying our podcast now because we wrote about this 2 weeks ago, and then there was a Bloomberg article that almost quoted us. But what we said is what the market's worried about is AI is going to replace software companies, but AI is not going to make much money. So AI is going to replace everything, but have really thin margins. It's going to be this dominant market destroying technology with very low profits. And that's what the stock market's saying. We don't like software companies. We don't like AI companies, this whole thing. Who's going to win? We as consumers, except for what? We won't have any jobs. So why is productivity so high? What is productivity? Productivity is real GDP growth minus labor growth. What is real GDP? It's GDP minus inflation. So that's what productivity is. So we had really strong, really good real GDP growth last year. What was labor growth last year? Pathetic. And it keeps getting worse, more pathetic. They keep adjusting the numbers. They adjusted it down to 30,000 jobs a month. And then they cut it to what? 15,000, right? We talk about that. Pretty amazing. That's a pretty good big adjustment, right? Remember President Trump fired someone because they made the first adjustment. I don't know if they fired someone for the second adjustment. 15,000 jobs is pathetic. That's a terrible. We need about 150, 200,000 jobs just so that you guys will have jobs. Just so there's enough jobs for you to get a job when you graduate. 15,000 jobs is pathetic. So our productivity was really strong last year, but it wasn't really, because there are people thinking all this AI investment is artificially inflating our GDP. So you got a lot of questions there. Those are the kind of things I would bring up in an interview because that's what they're looking for, those insights. So you have productivity growth, and then you have labor growth. So productivity long-term in the US has been about 2%. Labor growth historically has been about 1%. Then you have inflation. Inflation's been about 3%, but we'll say going forward, maybe 2%. Our economy can grow about 5%, maybe 4 to 6% economic growth. Oops. This is not real economic growth. This is nominal. Why is it nominal? Because I'm including inflation. One of our alums, Corey DeAngelis, he's making a name for himself. He's got some enemies, to be sure. There's people who hate him very intensely. They have T-shirts with an X through his picture. They really hate this guy, but he does a lot of education reform, and he posts constantly about how spending on public education is up 80% in real terms. And these people come back and say, yeah, but when you adjust it for inflation, it's not that much. And he goes, that's what real means. And it's gotten so comical now that his friends actually are starting to post that. Well, what about inflation? Just to irritate him. So no, nominal means you're including inflation. Real means you're subtracting inflation out. So this 2.2 with inflation, maybe it was 4.7 or something. Inflation was about 2.5 to 3%. So going forward, economic growth of 4 to 6%, that's what earnings growth will be. And you add a 2% dividend yield on top of that, maybe 2.5% with stock buybacks. US stocks can maybe make you 7 to 9% going forward. And that's a pretty decent assumption. For international stocks, developed market stocks have slower growth in the US. There's a lot of debate. Why is Europe so slow growth versus US? The US, I don't know if y'all noticed, we used to be the same wealth as Europe, what, about a decade ago, and now we're much wealthier. I think someone said the state of Mississippi is wealthier than Europe now. And Mississippi's been a turnaround situation. I don't know if you noticed their public education system and just what it's done. Huh?
Just the entire.
The overall Mississippi is much richer than, you're talking about just per capita GDP. Yeah, so just it's pretty amazing, right? Europe is not doing well. So do you expect that going forward or not? How do you make those adjustments? You know, you have to kind of see Japan's kind of turned the corner. South Korea, we've been talking about in our podcast, has really turned the corner and looks pretty exciting. Japan has a new president who is very, very interesting. South Korea has a new president. We'll talk later about how important a new CEO is to the risk of a company. New presidents are pretty material. So yeah, it's been interesting. We know healthcare costs a lot more in the US than in Europe, but that's probably more than offset by energy being so much cheaper in the US than in Europe. So you have these offsetting things. But yeah, stocks, expected earnings growth. Productivity is pretty key. Productivity is somewhat reliant on your educational system. So I'm hoping Corey DeAngelis can actually fix that. He might be Secretary of Education here one of these days, but then he wants to shut down the Department of Education. So maybe destroy his own job. But you know, it's interesting, the debates on education. I get into it a lot because we have an educational program in Costa Rica. Y'all didn't get to see it on your trip, but Darcy, y'all didn't get to meet Darcy, did you? I think she was on vacation. But we have a foster care program. We have our own tutor. And so I've been trying to find some AI laptop solutions that she could, because she's teaching 6-year-olds to 18-year-olds in a one-room, saying our university, we raised money and got her 6 laptops, but now we need some software. So who knows if AI might revolutionize education, but how good was y'all's education? Do you want your kids to have your exact education, or would you want it to be much better? So was it private or public?
What?
Yeah,
Oh.
public. Mine was 40% good and 40% horrible, depending on the teacher. I had 1 year, 6th grade, which was a complete waste. 1 whole year where I learned nothing. So yeah, it's hit or miss. But yeah, education is gonna be a big part of this. But they're on alternatives, they're kind of tough to forecast. You can look at historical numbers, but that may not get you going forward. You have to look at supply, demand. There's all kind of things going on there, so that one's kind of tough. But For gold, I'm going to put gold into your model. I'm just going to use what I think inflation is going to be, maybe 3%, and plug that in. So on expected return, you have to spend quite a bit of time on that. You can't just use historical numbers on that, especially our stock market has had really high returns, but that's because inflation was somewhat pushing that up to a higher number. For risk and correlation, we tend to use a lot of history there, and that's what I'm going to use on your model, but we know it's pretty unstable, and we'll see that. Bonds, so here's my proof on bond yields. The blue is the starting yield. The red is what you realize. And you can see in a crisis, it doesn't do so well, but it's a pretty decent forecast for how bonds will perform. The average yield, starting yield was 497. The actual experienced yield, our return was 4.4%. So for bonds, I used to use, for investment grade bonds, I used to use the starting yield. For stocks, here is the dividend yield plus earnings growth of the US stock market. The blue line is the actual stock market return. The red line is each decade's starting dividend yield and that decade's earnings growth. Here's the roaring 20s. Here's the Great Depression. Here's the sell-off in the 70s. Here's the dot-com sell-off. Here's the 2008 crisis. I haven't updated this, but stocks look pretty expensive right now. Relative to this, are they expensive or not? I can make an argument that they're very overpriced, and I can make an argument that we had a one-time adjustment. So you could go either way. What really happened during that period? What happened here is the cost of investing in stocks dropped dramatically. So you got that extra return. So essentially for that argument, this was the efficiency gain, and going forward, the red and blue lines will move together. That's kind of my argument. The other thing is the information revolution. Risk has come down because we have so much more information. So that's the other argument. Those are two one-time adjustments that made the blue lines shoot up. Going forward, they'll go parallel again. It's kind of argument.
Is it one sector that's making stocks really expensive, or is it like the tech sector?
I mean, that's tech and this is tech. So yeah.
With AI, even more.
Here you can see it actually came down to the line in the 2008 crisis. Most of this is growth stocks coming back up. But yeah, tech has been the last two bubble. It's hard to say what this bubble was, or even if it was a bubble. The dot-com, it didn't bring it down to the red line. But I mean, the market's going up, even though earnings growth has been pretty pathetic. So stocks could be overpriced, or we just had these two big adjustments. You have to kind of decide which of those two you believe. You can use the CAPE model, so it's out there for free. Just type Robert Siller data, and you can get that Excel spreadsheet. He does something kind of similar to this, but he more incorporates inflation. I did incorporate the buyback yield because stock buybacks have become a bigger number than dividends. It has a small impact. It's not enough to make up the difference, and I incorporated it in here. So over the long term, it works really, really well. But the last few years, yeah, stocks are moving way ahead of that line. Here's corporate earnings growth versus the economy growth. There you can see the blue line is corporate earnings growth, and the orange line is economic growth. Corporate earnings is much more volatile. Who caused the big spike in 2008? Anybody know which discipline that is in the College of Business caused this? The accounting profession, what did they do? They say, hey guys, let's do fair value accounting. It'd be so wonderful. Let's mark those bonds to market. What did bonds do in 2008? They fell a massive amount. So this is the repricing of bonds by insurance companies and banks. At UTSA, we were writing bonds down $4, $5, $6 billion because bond prices were down. So all that's due to the accountants. What happened in 2009? Wrote them right back up. So that's all the accounting. That wasn't true back here. So the accountants caused that particular crisis. But over the long run, corporate earnings grow about the same speed as our economy, but just with much more volatility. Here's rolling standard deviations of the major asset classes. You'll notice that bonds are pretty stable, around 4 to 5%. So that's kind of nice. High yield, not so stable. Can you see where the 2008 crisis is, anybody? And then stocks all got much riskier. Emerging markets got really, really risky. So what standard deviation do you assume for your clients? Do you assume 20%? Do you assume 10%? 25%? What do you use for your client? If you assume 20%, what are you going to do? You're going to put a lot of their money in the small cap stocks, right? I mean, if you assume 10%, if you assume 25%, you won't buy any small cap stock. It won't be worth it. So which number do you do? If you do this, they're going to be shocked and horrified. You do this, you buy nothing but cash, and they're going to be really upset, and stocks make 20, 30%. How do you handle assumptions when you only get one assumption and it moves like that over time? Any solutions? Well, the actuaries have one. It's called stochastic modeling, right? You do simulation, that works a lot better. So I like simulation a whole lot better. You get a crisis. But when you're doing efficient frontier, you only get one input. You got to decide what input you're going to use. Same thing with, oh man, we don't have a whole lot of time. 8 sigma. How many 8 sigma events do you see in your lifetime? You remember 8 sigmas? Remember where Bill Gates stopped at 7.9? So what's the chance of you seeing an 8 sigma event in your lifetime? Maybe once every 6 trillion years, you should see an 8 sigma day. And we didn't see any in the 50s. We didn't see any in the 60s. We didn't see any in the 70s. We saw 3 in the 80s. They all happened when? October 87, when the market dropped 23% in a day. Didn't see any in the 90s. In the 2000s, we saw 5. What year was that? 2008, right? We did see some in the 2020s. When did that happen? In 2020, right? COVID. So I don't know if we had 8 sigma days. We'll look and we'll see. We saw some 8 sigma days on interest rates. Interest rates did crazy things during COVID, which was kind of really ridiculous. But that's when the 10-year treasury got down to like 0.4%. That's a crazy number. So these should have never happened. If you're doing stochastic model, do you want to use stochastic model to actually create some of these 6 sigma events? Because if we're doing efficient frontier with standard deviation, they'll never come up. They'll never exist, but they obviously do exist. Or what's your other approach? Never happen again, never happen again. That's our solution. Tell your clients, we fixed, you don't have to worry about 2008 or 1987 because we're assuming they'll never happen again. So just want to let you know we're taking care of you there. And here's the rolling correlations. How stable are those? Not very stable at all, right? So this is where I ask the question, are stocks, here's stocks versus bonds. This is all versus large cap stocks. Are stocks and bonds positively correlated or are they negatively correlated? And the answer is yes, they are. When are they positively correlated? When they negatively, they're normally negatively correlated. But when are they positively correlated? During a recession. I mean, during inflationary periods, during inflationary periods. Now, we're going to talk what we mean by bonds here, because I'm going to show you a video of a very famous guy whose name I can never remember. I get him mixed up with a Russian composer, but he wrote a book called Random Walk Down Wall Street, and I'll show you his video. And he cheats. I wish he was here. We need the AT&T guy and this guy in the room so I can debate them. He cheats. When he wants to show the great job bonds do of diversifying your portfolio, he loves to use treasuries. But how many people buy treasuries? Hardly ever. Most portfolios are corporate bonds, not treasuries. So you notice in 2008, the correlation actually jumped. Why? Because I'm using a corporate bond portfolio. I'm not using treasuries. If I had used treasuries, what would have happened? It would have dropped down. Does it matter whether you're talking about corporate bonds or talking about treasuries? Absolutely, it does. If you use an index like the Merrill Lynch index or the old Lehman index, the Barclays index now, that index can be 70% mortgage-backed securities and treasuries. Whereas most investors are buying almost entirely corporate bonds. Makes a big deal. But people are selective. I want to show them how good diversification works. Oh, let's use a treasury index. That's not very honest at all. So 2008 bonds, corporate bonds sold off a bunch in 2008. And if your clients say, hey, don't worry, we got bonds, your portfolio diversified. Yeah, you need to ask which bonds. So there are times you actually want to separate the treasuries from the corporate bonds because they really are very different asset classes. In a crisis, normally they move pretty close together, but in crisis, they don't. What did you notice about all the stock asset classes? You remember in class when I was taking the correlation down to 0.9, 0.8, and the line just barely budged. There's not much diversification benefit on using international stocks, emerging market stocks. And especially in a crisis, what do you notice here? They're all up there at 0.9. There's almost no diversification benefit whatsoever. So you got a problem here with stocks versus bonds where it's not very stable. And within stocks, they've kind of all moved together. International stocks have that one huge benefit of currency. So you do get that currency diversification, which can help you. What's the expected return on currencies? Essentially zero, right? So you're just picking up correlation, you're picking up risk, but you're not picking up any expected return with correlation with currencies. So it's tough. To use an efficient frontier, we got to pick one number. And with stocks and bonds, that's tough. So how can you solve this? Stochastic modeling is a good way to solve it. You can have these things move through time. The way I did it with our stochastic model is because we had to put in correlations in the table, but I told it, hey, if the US stock market falls more than 30%, I want everything falling 30%. I force it to go out to the extreme. I don't want small cap helping me in a major crisis because it's just probably not going to do that. So it's tough. Here's February 2009, the end of that crisis. What helped you here? Fixed income. Here I'm using an index that probably includes treasuries and mortgage backs. High yield didn't help you. Here's a typical 70-30 allocation. What does Vanguard tell you to do? Is it tell 20-year-olds to do? 90% stocks, 10% bonds. I don't believe that at all. You should just go 100% stocks. There's no reason. 10% in bonds. I don't know anyone in 2008 going, boy, I'm glad I had that 10% in bonds. I could have lost 40%. I only lost 39%. I'm so happy I had that bond portfolio there backing me up. You're not going to notice it. I think when people say 90% stocks, 10% bonds, they're making two mistakes. First of all, we don't think about risk that way. We don't notice a difference between losing 38% and losing 40%. How are we thinking? I just lost a lot of money, right? We're not there. Wow, it could have been 40. What's the other thing that we're messing up on? So if I'm 90% stocks and 10% bonds, that's my cash allocation. But what is my risk allocation? Am I 90%? Is 90% of my risk in stocks? How much of my risk is in stocks? Probably 97%, because they're much more volatile. So you almost have nothing protecting you on the bond side. Almost all of your, so you might as well just go all stocks. And then don't look at it. I do believe, we're out of time, I do believe the US stock market does horribly during your lifetime. So did everything else. Real estate, bonds. So it doesn't really matter. You're sunk anyway. You're working till you're 90. So it doesn't really matter. Probably not going to happen, but if it does happen, diversification will help you anyway because everything's going to be terrible.